So picture this. It's 1952. You've got a 25-year-old economics grad student just sitting in a library at the University of Chicago.
A pretty unassuming setting for a total revolution.
Right, but he essentially proves, with pure math, that the entire global financial industry is, well, doing its job completely wrong.
Which is a bold claim for a grad student to make.
Very bold. But today, we're tracing how that exact moment, how one simple piece of folk wisdom, the whole don't put all your eggs in one basket thing.
Yeah, the classic proverb.
Exactly. How that proverb got transformed into this rigorous Nobel Prize-winning framework. The framework that literally birthed the multi-trillion-dollar engine of modern quantitative finance.
It really is a fascinating intellectual journey.
So if you're the kind of person who loves a good aha moment and you want to genuinely understand the invisible mathematical architecture running beneath the surface of the market without drowning in jargon, you're in exactly the right place.
Absolutely, because in this deep dive, we're going to unpack the architecture of what became known as modern portfolio theory, or MPT.
MPT.
We'll trace that leap from intuitive guessing to system-level financial physics. We'll look at the elegant equations governing risk, and then...
This is the fun part.
Yeah, then we'll critically examine why this beautiful frictionless theory can just, well, shatter when it actually collides with the messy reality of global markets.
Let's ground this historically first, because I want to set this scene. If we transport ourselves back to Wall Street in, say, the late 1940s or early 50s.
The era of Benjamin Grimm.
Right, exactly. The rise of strict value investing. How were institutional investors actually deploying their capital back then? Because from everything I've read in our source material, the concept of a portfolio as an interconnected web, it didn't really exist yet.
No, it didn't at all. The paradigm of that era was absolute isolationism.
Isolationism.
Yeah, financial analysis was almost exclusively focused on the individual security, just the single stock.
So they weren't looking at the big picture at all.
Not really. An analyst or a broker would take a company's balance sheet, dissect it, project future dividend yields, evaluate the management team,
Trying to find its intrinsic value.
Precisely. And if the stock was trading below that intrinsic value, it was deemed a good investment, period.
So you just buy it.
You'd simply gather the 15 or 20 best individual companies you could find and just put them in a vault.
So it was just an all-star highlight reel.
Basically, yes.
You just grabbed whatever looked fundamentally strongest on paper, totally blind to how those companies might react to the exact same external shocks.
Which is precisely the problem. I mean, risk was certainly acknowledged, right?
Sure, they weren't totally oblivious.
Exactly. Investors knew that a volatile mining company was inherently riskier than, say, a boring blue-chip utility, but risk was evaluated strictly on a case-by-case basis.
In a vacuum.
Right. There was no mathematical framework to quantify how the risk of the mining company actually interacted with the risk of the utility.
I was thinking about this, and it's kind of the equivalent of trying to build a championship sports team by purely drafting the players who score the most points.
Oh, that's a good way to look at it.
Right, like without ever asking if they actually complement each other on the court.
Yeah, you draft 5 superstar point guards who all need the ball to be effective.
Exactly. On paper, your team's aggregate scoring potential is astronomical.
But in reality...
They're going to trip over each other, nobody plays defense, and they lose.
Because the individual talent is totally irrelevant if their playing styles are basically redundant.
Right. If the correlation is highly positive, they're all doing the exact same thing.
And that structural redundancy is exactly what Harry Markowitz targeted. That was the focus of his seminal 1952 paper, Portfolio Selection.
The Chicago grad student.
The very same. Markowitz realized that compiling a list of individually excellent assets does not equate to an excellent portfolio.
Right.
He introduced a systems-level view of finance. He demonstrated mathematically that risk and return are inextricably linked. But more importantly, and this is the key, the risk of a portfolio is not merely the sum of its parts.
It's about how they move together.
Yes. It's defined by the covariance, the statistical interaction between the assets.
And that single insight just kicked the door wide open.
It completely changed the game.
But Markowitz didn't build modern finance alone. He poured the foundation, sure, but it was an entire cast of characters over the next 2 decades who built the skyscraper on top of it.
A very brilliant cast of characters.
Like William Sharpe, right, his protege. He takes this theory and bridges the gap to actual asset pricing.
Sharpe is a massive figure here. He recognized that if Markovitz's theory about how rational investors should behave was true, well, it would exert this massive, predictable gravity on how securities were actually priced in the open market.
Because everyone would be trying to optimize the same way.
Exactly. And this led Sharpe to develop the capital asset pricing model, or CAPM.
Which is still taught everywhere today.
It remains an absolute cornerstone of financial education.
Although, I have to point out, history tells us we probably should be calling it the Trainer model.
Ah, yes. Jack Trainer.
Right. Because Trainer, working completely independently over at Arthur D. Little, he actually drafted a manuscript outlining the fundamental concepts of CAPM almost a year before Sharpe published his work.
But he just never published it in a mainstream academic journal.
Which is wild. He
Yeah.
just relegated his own massive contribution to a footnote for decades.
It's the tragedy of the uncredited pioneer. It's actually a pretty common theme in economic history.
Yeah, I bet.
I mean, John Lintner and Jan Mawson, they also independently arrived at similar conclusions regarding capital asset pricing right around the same time as Sharpe.
It was just in the water, I guess.
It really was. And we can't overlook Fisher-Black either.
Oh, Black Skulls, right.
Exactly. Black absorbed these core concepts of equilibrium and risk-free portfolios and ultimately applied them to crack the seemingly impossible problem of option pricing.
It's an incredible intellectual lineage. From Markovitz's insight on correlation, all the way to Black and Scholes mapping the derivatives market. And it all culminates in Markovitz and Sharpe sharing the Nobel Prize in 1990.
A very well-deserved prize.
But to really grasp what these pioneers built, I think we need to look at the scaffolding they used.
The assumptions.
Yeah, because economists have this habit of building these perfect mathematical vacuums to isolate variables, right?
They absolutely do.
So let's boot up the Markovitz simulator. What are the strict underlying rules of this theoretical universe?
Well, the construction of a frictionless economic model is kind of akin to Galileo dropping objects in a vacuum.
Okay, to prove gravity.
Right. To prove that gravity accelerates all masses equally, you have to eliminate air resistance, because a feather and a bowling ball act very differently in the real world.
Because of the air.
Exactly. In financial physics, air resistance is market friction. So our source material outlines a very specific frictionless environment.
What's the setup?
We begin with a defined universe of $9 tradable assets, where $9 is simply greater than or equal to 2.
And the definition of an asset in this pure theoretical space,
Yeah.
it isn't just the S&P 500, right? It's literally anything that can hold or generate value.
Oh, the theoretical asset universe is completely unbounded.
Unbounded.
It encompasses global equities, sovereign debt, corporate bonds, commodities, real estate, consumer goods,
Everything.
everything. It theoretically extends to illiquid alternative assets too. Fine art, vintage wine, and even human capital.
Wait, human capital, like me.
Like you. The discounted present value of an individual's future labor income.
I just love the mathematical audacity of that.
Mm.
You're telling me we are optimizing a portfolio that theoretically includes fractional shares of a Picasso, a bushel of wheat, and a software engineer's future salary.
In theory, yes.
That's amazing. I mean, obviously an institutional asset manager in the real world restricts their optimization to a liquid sub-asset class, right? Like U.S. large cap equities.
Squirt.
But the math demands total inclusivity to function universally.
Because the equations, they just do not care about the physical nature of the asset. In this model, every single asset is stripped of its real-world identity.
It just becomes numbers.
It's reduced to exactly 3 statistical parameters: expected return, variance, and correlation.
The true DNA of financial physics.
Exactly.
So expected return being the probability-weighted average of all possible future outcomes.
Right.
Variance, or standard deviation, representing the spread or volatility around that expectation.
Yes, the bumpiness of the ride.
And correlation, which is the crucial innovation here, measuring the degree to which asset A's returns move in tandem with asset B's.
And this reliance on variance as the sole proxy for risk requires a massive foundational assumption about how markets behave.
Which is?
The assumption of elliptical return distributions, with the classic normal distribution, the bell curve being the most common application.
Okay, wait, which means the model explicitly assumes that stock market returns cluster neatly around the mean. And that massive multi-standard deviation crashes. Those extreme left-tail events are so statistically rare that they can essentially be ignored for the sake of optimization.
That is the assumption, yes.
Yeah, hold on. Anyone who lived through 1987 or 2008 or 2020 knows that the market does not behave like a neat bell curve.
It certainly does not.
We're definitely going to tear into that fat tail problem heavily later. But,
Yeah.
okay, for the sake of exploring the math, let's agree to operate inside the bell curve for now.
Fair enough. So operating inside that bell curve requires adopting the rest of the frictionless rules.
Right, the air resistance. What else are we vacuuming out?
First, we assume a static single-period investment horizon, meaning you allocate your wealth, which we denote as weights, summing exactly to 100% at the beginning of period $2, and you do not intervene until the period concludes.
So no day trading.
No dynamic hedging or rebalancing halfway through. You buy and you hold.
Okay, what about the real-world frictions that consume actual alpha, like fees?
Completely vacuumed out. The model assumes zero taxation.
Wow, sci-fi utopia.
Zero transaction costs or brokerage fees, too. Assets are infinitely divisible, meaning fractional investing to the 10th decimal place is perfectly fine.
Okay.
Furthermore, short selling is completely unrestricted, it's costless, and it requires absolutely no margin or collateral posting.
Okay, I have to push back a little here. No taxes, no fees, infinite shorting without margin, and I can invest in fractions of a wine bottle and labor income.
It sounds absurd, I know.
It sounds like a total fantasy. How can this be useful?
Well, remember the vacuum analogy. Removing transaction costs and taxes is the only way to expose the pure mathematical relationship between risk and return.
Okay, I'm listening.
If you introduce, say, a 20% capital gains tax and a bid-ask spread into the equations in 1952, the multivariate calculus becomes hopelessly unsolvable. It's just too muddy.
So the vacuum is strictly necessary to find the gravity?
Precisely. You have to distill it down to a pure mean variance optimization problem, finding the highest return for a given risk or the lowest risk for a given return.
All right, I'll accept the vacuum.
Yeah.
So assuming this perfect frictionless universe, how does the actual engine of diversification work?
Let's build a mental model.
Because we know intuitively that correlation matters, but I want to understand how the math actually melts the risk away.
To visualize this, let's construct a theoretical baseline, what we call a homogeneous market.
Homogeneous, so everything is the same.
Exactly. Imagine a universe where every available asset is essentially a statistical clone.
Okay.
Every single asset has an expected return of 10%, a standard deviation of 15%, and crucially, a correlation coefficient of exactly 0 with every other asset.
So they move completely independently of one another.
Yes. Now, if you invest your wealth equally across these dollar assets, allocating 1 divided by dollars to each one, your expected return never budges.
Because it's a weighted average.
Exactly. The average of 10% returns is still exactly 10%. The return is totally invariant to the number of assets.
But the risk.
The expected return is invariant, but the portfolio variance, the true measure of system risk, undergoes a radical transformation.
How radical?
Well, when you calculate the variance of a multi-asset portfolio, the formula isn't just the simple sum of the individual asset variances. The equation expands into this massive mathematical matrix.
Let's visualize that matrix, because I think this is where the aha moment truly lives for you listening. If you build a portfolio of 50 stocks, you have 50 individual variance terms, right?
Right, the standalone risk of each company.
But the rest of the equation is completely dedicated to covariance, how each stock interacts with every other stock.
Yes.
So for a 50 stock portfolio, you have 50 times 49 divided by 2.
Yeah.
That's 12,225 distinct covariance terms.
And that's just for 50 stocks. The math literally reveals that the interactions between the assets outnumber the individual traits of the assets by a factor of roughly 24 to 1.
That's wild.
As knowledge grows, the individual variance terms become mathematically trivial. The portfolio's total risk becomes overwhelmingly dominated by the average covariance between all those assets.
And in our homogeneous market example, where we explicitly said the correlation is 0.
Then those 225 covariance terms are all essentially 0.
So the massive bulk of the risk equation completely zeroes out. It just vanishes.
Leaving you with a portfolio standard deviation that shrinks proportionally to the square root of non-dollars.
Wow.
You maintain your 10% return, but the volatility plummets towards 0 purely by adding independent, uncorrelated assets.
This mathematical proof definitively separates risk into 2 distinct categories then.
It does. Idiosyncratic risk and systematic risk.
Okay, so idiosyncratic risk is the risk of a specific company's CEO resigning or a single factory catching fire. It's represented by those individual variance terms.
Right.
And as we just proved, if you hold enough independent companies, those idiosyncratic shocks just wash each other out.
Because one CEO resigns, but another company discovers a new product, they cancel each other out.
But there is an asymptote to this magic trick, isn't there? I mean, I can't just buy the entire Russell 3000 index and reduce my risk to absolute zero.
You cannot, because in the real world, correlations are almost never zero.
Right, stocks generally move together.
Equities generally move together in response to macroeconomic factors. Interest rate hikes, inflation data, global conflicts.
The whole market tide.
Exactly. Because average covariance in reality is positive, the risk reduction curve eventually flattens out.
Where does it flatten?
Our models indicate that the vast majority of idiosyncratic risk is diversified away by holding an equally weighted portfolio of roughly 30 to 50 randomly selected securities.
Wait, really? 30 to 50?
Yes, 30 to 50. After that, you hit a lower risk limit that cannot be crossed just by adding more stocks.
That is a staggering reality check. Because if you're a retail investor holding a 500 stock index fund, you might intuitively feel exponentially safer than your neighbor who holds a carefully constructed 50 stock portfolio.
You might feel safer, but the math tells a very different story.
You have both already hit the horizontal floor of the risk curve. You've both wrung all the idiosyncratic risk out of the sponge.
Adding the 501st stock does virtually nothing to lower your overall portfolio variance.
You are left entirely with systematic risk, the risk of the system itself collapsing.
Exactly. So to breach that floor, to push the portfolio variance even lower than what equities allow, you have to look beyond the boundaries of your current asset class.
Cross-market diversification.
Yes. Because if your 50 stocks are entirely concentrated in U.S. large-cap technology, their covariance remains relatively high. They all react similarly to tech sector news.
So you must integrate assets that respond differently to the same economic stimuli.
You blend in short-duration treasury bonds, which might actually exhibit negative correlation during an equity panic.
People flee to safety.
Right. You introduce hard commodities like gold or international real estate, which march to entirely different macroeconomic drums.
And by forcing assets with near zero or negative correlation into that massive matrix, you actively drive down that average covariance term.
Which lowers the absolute floor of your risk profile.
It's just brilliant. And when you map out every conceivable permutation of these assets, millions of different weightings across stocks, bonds, and commodities, you generate this massive plot on a graph, right?
Yes. With risk, or standard deviation, on the horizontal x-axis and expected return on the vertical y-axis. This cloud of millions of possibilities is what we call the opportunity set.
But a rational investor, someone operating purely on quantitative logic, they would never select a portfolio floating somewhere in the middle of that cloud.
Why would they?
Right. If you are going to endure, say, 12% volatility on the x-axis, you demand the absolute highest mathematically possible return on the y-axis.
You want to reside on the very top left boundary of that cloud.
And that boundary has a name.
That boundary is Markowitz's efficient frontier.
The efficient frontier.
It represents a continuous curve of optimal portfolios. It shows the maximum possible return for every single increment of risk.
Starting from the far left.
Starting from the global minimum variance portfolio on the far left, the absolute lowest risk possible, all the way to heavily concentrated, high-risk, high-reward portfolios on the top right.
Any portfolio resting below this curve is mathematically inferior.
Literally suboptimal.
Okay, so we've built the best possible portfolio of risky assets. We've mapped the frontier. But the financial system isn't composed entirely of volatility.
No, it isn't.
How does the architecture of this theory react when we introduce an asset that theoretically carries zero risk? Because from my understanding, introducing a truly risk-free asset completely shatters the geometry of that efficient frontier curve.
It does more than shatter it. It transforms portfolio theory from a simple selection exercise into an absolute asset pricing revolution.
Okay, let's unpack that.
In financial economics, we require a proxy for absolute certainty. So we typically utilize a short-term sovereign debt instrument, like a 3-month U.S. Treasury bill.
Because it's assumed to be backed by the full faith and credit of a government capable of printing its own currency.
Exactly. So we define this risk-free asset by 3 parameters. First, its expected return is a known fixed constant. We denote that as dollars.
Okay.
Second, because the return is totally guaranteed, its variance or volatility is exactly zero. It never deviates.
Zero risk.
And third, because it is an absolute constant, its correlation with literally any other risky asset, equities, commodities, whatever, is also fundamentally zero.
Right, because a flat line doesn't correlate with a jagged line.
Precisely. Furthermore, under our frictionless assumptions, investors have infinite capacity to both lend and borrow at this exact rate, $3.
Okay, so returning to our graph. Risk on the bottom, return on the side. Where does this new asset sit?
Because the risk-free asset has zero volatility, it exists as a single point squarely on the vertical y-axis, exactly at the height of $3.
And here's where the math does something just beautiful. When you combine this perfectly stable asset with any risky portfolio on your curve-efficient frontier, the resulting combinations do not form another curve.
No, they don't, because the variance and correlation of the risk-free asset are zero, that massive complex covariance matrix we talked about. It evaporates.
The relationship becomes perfectly linear.
By allocating portions of your wealth between the risk-free rate and a risky portfolio, you draw a perfectly straight line extending from the axis out to the curve.
And your total portfolio risk and return simply slide up and down that line proportionally.
Exactly. If you put 100% of your money in the risk-free asset, you sit exactly on the y-axis.
Earning dollars.
Right. If you put 50% in the bank and 50% in the risky portfolio, you sit exactly in the middle of that straight line.
But obviously you want the most efficient line possible. You want the line that gives you the highest vertical return for every horizontal step of risk you take.
Naturally. Therefore, you anchor your straight line at the risk-free rate on the y-axis, and you pivot the trajectory upwards. You tilt it until it just barely grazes the absolute upper edge of your curved efficient frontier.
Just touching the very edge.
It touches the curve at exactly one distinct mathematical point.
The point of tangency.
The tangency portfolio.
Wow.
This single optimal mix of risk-free assets is the holy grail of modern portfolio theory. Because that straight line, which we now call the capital market line, it entirely supersedes the old curved efficient frontier.
Because for any given level of volatility you are willing to stomach, sitting on that straight line will always yield a higher return than sitting anywhere on the old curve below it.
Always.
This fundamentally alters how we should think about risk appetite, doesn't it? The math suggests that your personal risk tolerance shouldn't dictate which stocks you buy.
Not at all.
It should only dictate how much cash you hold.
This is known in the field as the separation theorem. The decision of which risky assets to hold is entirely divorced from the investor's individual risk aversion.
So it doesn't matter if you're a conservative pension fund or an aggressive day trader.
According to Markowitz, you should both hold the exact same basket of risky assets, the tangency portfolio.
Let me try to ground that with an analogy for the listener. Think of the tangency portfolio like the perfectly optimized fuel-to-oxygen mixture in a high-performance combustion engine.
Okay, I like engines.
The engineers have solved the exact stoichiometric ratio to generate maximum power with minimum waste. That mixture is the tangency portfolio.
And the risk-free asset.
It's the throttle.
Ah, perfect.
If you are a conservative investor, you don't mess with the fuel mixture. You just barely open the throttle. You keep 90% of your wealth safely in the bank and only allocate 10% to the high-performance engine.
And if you're an aggressive trader?
You push the throttle wide open, you allocate 100% to the engine, or you even borrow money at the risk-free rate to leverage your exposure to 200%. But the structural composition of the engine itself, the stocks you hold, never changes.
That is an excellent way to visualize the separation theorem. And, to stick with your analogy, we actually measure the fundamental efficiency of that engine using what's called the Sharpe ratio.
Named after William Sharpe.
Yes, it represents the mathematical slope of that new straight capital market line. The formula simply calculates the portfolio's expected return, subtracts the risk-free rate to isolate the excess return, and then divides that premium by the portfolio's total standard deviation.
Right. It's asking, basically, how much excess horsepower are you generating per unit of whiplash endured?
Exactly. It defines the optimal market price of risk.
Now, the Sharpe ratio is elegant when you simply use the risk-free rate provided by the central bank. But from what I'm reading, the true power of this theoretical framework really reveals itself when we attempt to manufacture our own certainty out of pure risk.
Yes, synthesizing certainty. This brings us to the mechanics of arbitrage, which serves as the foundational enforcement mechanism of financial equilibrium.
Synthesizing certainty out of volatile assets. To pull this off, we need a mathematical anomaly, right? Perfect negative correlation.
Denoted statistically as a correlation coefficient, or rho of -1.
Okay, rho of -1.
While incredibly rare in the physical world, perfect negative correlation is the fulcrum of financial engineering. If asset A and asset B exhibit a correlation of -1, it means every upward movement in A is matched by a perfectly proportional downward movement in B and vice versa.
They're essentially perfect mirror images.
Exactly. And the math dictates that if you perfectly weight these two volatile assets against each other, their respective variances entirely obliterate one another.
They cancel each other out completely.
You have engineered what we'll call Portfolio Z. a synthetic asset with absolutely zero standard deviation.
Zero risk.
Zero risk. Now, Portfolio Z generates a specific expected return, which we denote as a LUZO-Z. Because Portfolio Z carries zero risk, basic economic logic dictates that it must be directly comparable to the actual risk-free asset, $3, offered by the sovereign bank.
Okay, let's play out the arbitrage scenarios to see how the market actually polices this relationship. Suppose the market is inefficient, right? And our newly engineered Portfolio Z is yielding 5%, while the central bank's risk-free rate is only 3%. What does a rational algorithmic trader do?
To exploit that spread to infinity.
How?
The trader borrows aggressively from the bank at the 3% rate. They deploy that borrowed capital to purchase the constituents of Portfolio Z. Because Portfolio Z mathematically guarantees a 5% return, the trader simply pays back the bank's 3% and captures a riskless 2% profit.
Wow.
They utilize absolutely no personal capital, and they assume zero market risk.
It's the literal definition of arbitrage, an infinite money glitch.
Exactly.
But what if the scenario is inverted? What if the synthetic Portfolio Z is yielding a paltry 2%, while the bank is paying 3%?
In that environment, the frictionless assumption of unrestricted short selling becomes vital.
Right, because we assumed that earlier.
The trader identifies that Portfolio Z is fundamentally overvalued and underyielding. So they execute a short sale on the underlying constituents of Portfolio Z, which generates immediate cash.
Okay, they take that cash proceeds from the short sale.
And immediately deposit it into the bank to earn the 3% risk-free rate. Meanwhile, the short position they owe only grows at 2%.
Oh, I see.
The interest earned on the deposit outpaces the liability of the short, locking in a riskless 1% profit.
Now, in a theoretical vacuum, these arbitrage opportunities offer infinite wealth generation. But in reality, the market acts as this aggressive, self-correcting immune system, doesn't it?
It does. The very act of exploiting the arbitrage destroys the arbitrage.
Right, because of mechanical pressure of supply and demand. If Portfolio Z is paying out that lucrative 5%, every quantitative hedge fund on Earth will attempt to borrow cash and buy the assets comprising Portfolio Z.
A massive tidal wave of buy-side demand?
And that demand instantly drives the price of those assets up. And in finance, when the current price of an asset skyrockets, its future expected return mathematically compresses.
It gets squeezed down. Conversely, if Portfolio Z is yielding only 2%, the massive wave of short-selling pressure artificially crushes the price of the underlying assets, which forces their future expected return upward. This
Ruthless high-frequency trading just acts as a hydraulic press. It forces the return of Portfolio Z to perfectly align with the risk-free rate dollars.
And once Mo Z equals the $1, the arbitrage evaporates. The market has achieved equilibrium.
Everything is priced correctly.
Every asset is perfectly priced relative to its risk. And while this sounds like esoteric textbook theory, it is actually the bedrock of modern derivatives.
Right, Black and Scholes.
Yes. This is the exact intellectual leap made by Fisher Black and Myron Scholes. They realized that you could construct a synthetic, risk-free portfolio by purchasing a stock and simultaneously short-selling a precisely calculated fraction of a call option on that exact same stock.
And because this combined position was mathematically risk-free, the equilibrium principle dictated it must earn exactly the risk-free rate.
Precisely. By anchoring the equation to the known risk-free rate, they were able to reverse engineer the formula to determine exactly what the option should cost.
They literally conjured the multi-trillion-dollar derivatives market out of the concept of no arbitrage equilibrium. It's breathtaking.
It really is an elegant piece of math.
But as powerful as Markowitz's selection theory and the arbitrage mechanisms are, we haven't fully solved the pricing problem for just the everyday asset, have we? How do we take this frictionless math and apply it to the messy reality of the broader stock market?
To bridge that gap, we have to return to William Sharpe and CAPM. Sharpe wanted to isolate exactly what portion of a stock's return is a reward for risk and what kind of risk actually warrants a reward.
Okay, so how does CAPM do that?
CAPM introduces a remarkably elegant linear equation. It states that the expected return of any asset is equal to the risk-free rate, plus the asset's sensitivity to the overall market, which we call beta, multiplied by the market's excess return.
The famous beta.
Yes. The equation fundamentally cleaves an asset's total risk into two distinct halves: systematic and idiosyncratic.
Systematic and idiosyncratic. Let's define those again in this context.
Systematic risk, represented by beta, measures an asset's covariance with the entire market portfolio. It is the unavoidable macroeconomic tide.
The water raising all boats or lowering them?
Right. Interest rate fluctuations, inflation shocks, geopolitical conflicts, these forces act upon all equities simultaneously. A beta of 1.0 means the stock moves in perfect lockstep with the market. A beta of 1.5 means it is 50% more volatile than the market tide.
And then you have the idiosyncratic risk, which the math nerds call epsilon.
Epsilon, yes. The residual variance completely detached from macroeconomic forces.
So if systematic risk is the weather like a hurricane that hits every business on the coast, idiosyncratic risk is a customer slipping on a wet floor in one specific local coffee shop.
That is an excellent visualization. If you are a concentrated investor and you hold shares in only that single coffee shop, the lawsuit from that slip and fall could bankrupt your entire portfolio. You are bearing massive idiosyncratic risk.
But if you hold a highly diversified 500 stock index fund, the financial impact of that one lawsuit is statistically invisible.
It vanishes.
The idiosyncratic risk of the coffee shop is perfectly canceled out by the idiosyncratic success of a pharmaceutical company discovering a new drug in your portfolio.
Exactly. And this leads to the most brutal, sobering realization of CAPM for traditional stock pickers.
Oh, I know where this is going.
Because idiosyncratic risk can be almost entirely eliminated through basic diversification. The market mechanism refuses to compensate you for bearing it. Wow.
In an efficient market, you are not paid a premium for taking on unforced errors. You are uniquely compensated only for systematic risk, the beta.
So your expected return is dictated almost entirely by your exposure to the unavoidable macroeconomic weather.
Yes.
The implication there is just profound. It means trying to find an undervalued company with a massive potential idiosyncratic upside is mathematically futile over the long run.
According to CAPM.
Yes, just buy the market, set your desired beta by leveraging or deleveraging with the risk-free asset, and go play golf.
That's the logical conclusion.
It's elegant, it's mathematically perfect, but it didn't hold up to empirical scrutiny, did it? The single-factor beta model started showing serious cracks.
It did show cracks, yes.
Yeah.
As computational power increased in the 1970s and 1980s, academics began running massive historical regressions on stock data, and they found persistent anomalies that CAPM just could not explain.
Well, small capitalization stocks consistently outperformed large-cap stocks, even after adjusting for beta. Value stocks companies with high book-to-market ratios consistently outperformed expensive growth stocks.
So the single factor wasn't enough. Beta didn't explain everything.
No. Which brings us to what John Cochrane famously dubbed the factor zoo.
The factor zoo.
Eugene Fama and Kenneth French really shattered the CAPM monopoly by introducing the Fama-French three-factor model. They added size and value as distinct systematic risk factors alongside the overall market beta.
They argued that small cap and value stocks outperformed because they were inherently riskier in ways that standard market beta failed to capture.
Exactly. But the dam had broken. Shortly after, Mark Carhart added a fourth factor, momentum, the phenomenon where stocks that have gone up recently tend to keep going up, which directly contradicts the efficient market hypothesis.
Right, because past performance shouldn't predict future results if the market is perfectly efficient.
Exactly. And from there, it just spiraled out of control. Over the last 3 decades, quantitative analysts and academics have proposed hundreds, perhaps thousands of distinct factors attempting to explain excess returns.
Quality, low volatility, liquidity, profitability.
Yes. Cochrane called it a zoo because it became a chaotic mess of data mining.
Because they were just fishing for patterns.
The factor zoo perfectly illustrates the collision between beautiful theory and messy reality. With the advent of machine learning, algorithms can dredge through decades of financial data and find spurious correlations that look like systematic factors, but are actually just statistical noise.
Which has led to a massive replication crisis in financial economics.
A huge crisis, yes.
Which provides the perfect transition into the final and, I think, most critical phase of our deep dive today. We've built the frictionless matrix. We understand the math. But our source material dedicates a massive section to the fundamental flaws of modern portfolio theory when deployed in the real world.
The drawbacks.
The biggest vulnerability being what they call dimensionality and parameter estimation.
Right. In computer science, there is an axiom. Garbage in, garbage out, or GGO.
GGO.
Markovitz's mean variance optimizer is a hyper-logical, ruthless, algorithmic engine. It possesses no intuition, no common sense, and absolutely no awareness of economic reality.
It's just math.
It simply solves the multivariate calculus based precisely on the parameters you feed it.
And those parameters, the expected return, the variance, and the covariances are just estimates, right? They're educated guesses based on historical data.
That's the problem. If your estimate for a stock's expected return is off by even a fraction of a percent, the optimizer might output a corner solution.
What's a corner solution?
It might demand you allocate 80% of your entire wealth into that single volatile asset just because the math technically optimizes based on that tiny error. It maximizes your mistakes.
That's terrifying.
The estimation of the covariance matrix is difficult, but it's mathematically manageable over shorter time frames. The fatal flaw lies in the estimation of expected return.
Because you can't predict the future.
Our models assume statistical stationarity. They assume that the underlying distribution of returns remains constant over time.
Meaning the average return of the last 50 years is a reliable predictor of the average return of the next 50 years.
Yes. But finance isn't physics. The gravitational constant doesn't change, but the global economy radically restructures itself constantly.
Exactly. To achieve a statistically significant estimate of true expected return, econometricians calculate that you would need hundreds of years of uninterrupted stationary financial data.
Which is an impossible prerequisite. Almost no corporate entity has existed for 300 years, and even if one had, the data is entirely corrupted by regime shifts.
I mean, the return data of a railroad monopoly in 1890 tells you absolutely nothing about the expected return of a cloud computing firm in 2026.
The data is fundamentally non-stationary. The optimizer requires a level of prescience that simply does not exist.
And the vulnerability extends beyond just parameter estimation, too, because we have to revisit that assumption we made at the very beginning, the reliance on elliptical or normal distributions to model risk.
The bell curve.
Right. MPT defines risk purely as standard deviation, which assumes that market returns cluster symmetrically around the mean and that massive deviations are exponentially rare.
But anyone who studies financial history knows the bell curve is a dangerously inadequate map.
Let's look at the crash of October 1987, Black Monday. The Dow Jones dropped over 22% in a single day.
An incredible event.
If you calculate the probability of a 22% single-day drop using a standard normal distribution, it is an event so infinitesimally rare that it shouldn't happen even once in the multi-billion-year lifespan of the universe.
And yet
it happened on a random Tuesday in 1987. Actually, it was a Monday, hence the name, but you get the point.
Because financial markets exhibit what we call fat tails, specifically fat left tails.
Fat tails.
Benoit Mandelbrot famously critiqued Markowitz for this, arguing that financial markets are fractal and prone to wild, unpredictable volatility flustering. In reality, extreme catastrophic crashes, the left tail events occur with orders of magnitude greater frequency and severity than the mathematics of MPT allow for.
So by defining risk strictly as standard deviation within a normal distribution, MPT systematically blindfolds the investor to the true probability of absolute ruin.
It does. This is why modern quantitative firms don't just run MPT optimizers. They run aggressive Monte Carlo stress tests specifically designed to simulate left-tail black swan events.
So we face a really profound dilemma here.
We do.
The required data parameters are impossible to accurately estimate. The optimizer maximizes our errors, and the underlying definition of risk completely ignores catastrophic tail events.
It sounds bleak when you put it like that.
Well, I have to push the ultimate challenge here, then. If the inputs are garbage, the optimizer is ruthless, and the map ignores the cliffs. Is modern portfolio theory essentially just a beautiful academic fantasy? Should practitioners just abandon it entirely?
Abandon.
I mean, figures like Ray Dalio have pioneered models like risk parity, which attempts to ignore predicting expected returns entirely and just balances a portfolio based purely on risk contribution. Or the Black-Litterman model, which reverse engineers the optimizer to prevent those crazy corner solutions we talked about. Are these admissions that MPT is basically dead?
It is not an admission of death. It is an evolution. I would aggressively defend MPT not as a literal blueprint, but as the foundational philosophy of risk.
Okay, a philosophy.
You cannot treat the mean variance optimizer as a crystal ball. If you blindly feed it historical Yahoo Finance data and execute the output, you will likely suffer massive losses.
So it's not a GPS, it's a compass.
Exactly, a compass. It provides the definitive vocabulary for understanding market dynamics. Before Markowitz, we lacked the mathematical language to even articulate why diversification worked.
True.
MPT proves the geometric value of uncorrelating assets. It provides the engine of equilibrium that makes options pricing possible. It forces us to distinguish between the idiosyncratic risk we can wash away and the systematic risk we must demand compensation for bearing.
So the principles stand.
The exact numerical outputs may be flawed, but the relational truths MPT exposed are ironclad. Every modern theory, risk parity, black letterman, multi-factor models, is simply a structural modification built upon the foundation Markowitz poured in 1952.
That's a great defense. We have mapped an incredible expanse of theoretical terrain today. We started in the isolationist era of 1950s stock picking, followed Markowitz right into the frictionless vacuum to discover the staggering power of the covariance matrix.
And rode the capital market line all the way to the tangency portfolio.
We observe the brutal mechanical efficiency of the market's immune system as it enforces equilibrium through arbitrage. And we dissected the CAPM equation to understand the weather versus the dropped coffee cup.
And finally, we confronted the sobering reality of the factor zoo, the G.I. Joe paradox of ruthless optimizers, and the fat tail reality of a market that refuses to be contained by a simple bell curve.
It is a testament to the beautiful, messy attempt to translate human panic and greed into cold mathematics. As we wrap up this deep dive, I want to leave you with a final thought to ponder.
I'm intrigued.
We've spent the better part of an hour exploring how to mathematically isolate and completely eliminate idiosyncratic risk, the unpredictable, unique quirks of a specific company.
Yes, the math says wash it away.
The models scream that idiosyncratic risk is mathematically worthless. Diversify it away.
Right.
But consider the current landscape. We live in an ecosystem dominated by algorithms, high-frequency trading supercomputers, and machine learning models that can instantly optimize portfolios.
They perfectly hedge systematic beta and ruthlessly exploit arbitrage in milliseconds.
Exactly. The machines have conquered the systematic math. So perhaps, in an era where everyone has access to the exact same frictionless optimizer, the only true alpha left for the human investor is the idiosyncratic.
Oh, wow.
Maybe that unpredictable, unmodelable human element, an intuitive read on a visionary founder, a contrarian thesis on a niche consumer trend, the spark of a truly bizarre idea. Maybe that is the singular edge the algorithms cannot price in.
Because they can't quantify intuition.
Right. So think about that the next time you review your allocations. Are you merely trying to be a subpar algorithm, perfectly diversified and mathematically invisible? Or are you willing to embrace the one chaotic, idiosyncratic variable the math insists on throwing away?
A fascinating paradox to leave the listener with.
Thank you for joining us on this extensive journey through the architecture of financial physics. Keep questioning the models, and until next time, make sure you know exactly how the baskets holding your eggs correlate with each other.